Hey everybody, Economic Ninja here. It's like, where's the ninja? Where's the ninja? Ninja broke down this morning. I found myself in Barstow. Now it's going to be like the Indianapolis 500. If you've ever been to Vegas before, you know, from Barstow to Vegas, it's on like Donkey Kong. And I'm in my truck, so it's not going to go that fast. Or will it? Sorry, I digress. Let's talk about what just happened. A warning from top JPMorgan strategists saying out of Market Watch, investors should shun stocks and bonds as U.S. economy shows shades of 2008, baby. Yeah! Oh, sorry. It's a little loud. Hopefully nobody ran off the car. Woo! Okay, here we go. All right, here we go. Hey, real quick. Someone said roll call. Roll call number one, if you're from Ninja Nation, put it down below. All right, here we go. A top JPMorgan and Chase company market strategist is urging clients to shun both bonds and stocks. Oh my gosh, there's a Johnny Bravo lookalike right here. Stand by, stand by. This is getting weird. Come on, how do you turn this around? Come on, look at him. Look at him. Look at that hair. Is that Johnny Bravo or what? Made you famous. Sorry, I'm so childish. Squirrel. All right, real quick, stand by. Okay, don't fall, guys. Don't fall. This is getting awkward. Oh gosh, this is it's so unprofessional. Ninja, you're supposed to be a professional at something. A professional dork. All right, here we go. Stay. All right, sorry. I'm back to the news. It says right now, a top JPMorgan Chase company market strategist is urging clients to shun both bonds and stocks in favor of cash after spotting shades of 2008 in contemporary U.S. economy. He must watch the ninja. It is crazy how much alike this is to 2008, yet it's bigger. It's like the supersize me of economic fiascos. In his latest note to clients, JPMorgan's Marco Klovanovic, who earned the nickname Gandalf after a series of a series of good market calls back in 2015, warned that the U.S. economy looks about to slide into pushing into recession. That makes no sense. As interest rates and bond yields climb. Man, this guy went to school for this stuff. Neither stocks nor bonds are safe, he said, and urged clients to keep their cash and enjoy relatively risk-free 5% returns. Wait a minute. If you're getting 5% returns, you're in the bond market, or a money market account that's in the bond market. Did this guy really go to school? Oh, he probably didn't. He probably different major. Probably switched it. Aquatic basket weaving. Put down below what you think is a Kolonovic. Maybe his major was in colonics. Said he sees shades of 2008 in rising bankruptcies and consumer loan defaults, which have coincided with the erosion of COVID-19 cash cushion that helped insulate many of the effects of rising borrowing costs. Isn't that crazy? He's just saying what's already happened. Is it just me, or does this happen a lot? Economists are like, look at me, I'm an economist. What's going on in the future? Don't know, but I can tell you what happened in the past. You're like, you're worse than a weatherman. At least the weather person is trying to actually predict, okay, there's no clouds today, see it? But tomorrow, I think there's going to be clouds. He's not even doing that. He's like, well, the commercial real estate's falling. Bond yields are rising. But the monetary policy lag that has so far helped the U.S. economy avoid a recession and wearing off. No, it's because Joe Biden changed the dude that falls upstairs? The guy that, has cocaine in the White House? He changed the definition. So whoever believes him has got to be dumber than him. This is your competition, everyone. Now, Kolonovic is focusing on rising borrowing costs, which have increased by an even greater magnitude since the Federal Reserve just started raising interest rates last year than they did just before the financial crisis. Is there anybody in Vegas right now waiting for me to show up? Just type 2 below. I'm just really curious. I bet you people are like, where are you? Why are you stopping for a live stream? Someone's got to go to the restroom. Okay, moving on. Kolonovic sees it as an expected slowdown in fiscal spending could add to the U.S. economic woes, while tensions evolving in China, Russia, and other nations create new geopolitical risks that could potentially trigger bursts of volatility. In his view, the headwinds facing stocks have only intensified since earlier this year when Kalanick Vic stood by his bearish stance, even as the S&P 500 and NASDAQ Composite powered higher, while the strength of both markets and the U.S. economy took many on Wall Street by surprise. I bet you he's watching right now. He's like, dude, my name's not Kalanick. I've done that before. It's not pleasant. It's not pleasant. Type 3 if you've ever done a colonic. Okay, wow, it's exactly allogenous. That's a big word. The economic backdrop in the U.S. rhymes with the years preceding the financial crisis, Kalanovic says. As rising rates threaten to punish overextending consumers and businesses. Now, if Kalanovic remembered economic history, monetary policy history, whatever you want to say, rates actually dove down starting in 2006. They really were already diving down before the recession of 08. So the current change in interest rates is about 5 times larger than that of 2002 to 2008 increase. Of course, consumer balance sheets, and leverage in real estate markets and the financial industry were higher going into 2008, but investors should carefully monitor the propagation of interest rate shock across markets and divergent segments of the economy, Kalanick said. He also expressed skepticism about the long-term impact of the artificial intelligence craze. Oh, this guy's a nutball. I'm going to be honest with you right now. Type 4 if you think that artificial intelligence is going to take a lot of jobs over the next couple of years. Type 5 if you think everything's fine. And you just watched Annie. And yes, the sun will come out tomorrow. Just curious. Yeah. Okay. Looks like most of us are together. All right, cool. Can AI change the economy and offset the negative impact of inflation and interest rates? We think no. Yeah, well, I actually agree with that. AI could boost the stock market in a speculative foundation like it did earlier this summer. Some of the wealth effect from high stock market valuations could also pass. Ooh, that's called a bubble. Kalanick, that it's just like the marijuana thing and the crypto thing. That's what happened. I'm just making sound effects. I'm trying to get down to your level. I know you went to Coolidge. U.S. stock, and I'm not knocking Coolidge. Better than Hodge. U.S. stocks finished mixed Wednesday with blah, 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 blah. And the 15th anniversary of collapse of Lehman Brothers, which unshared in the most chaotic period of the financial crisis. Hey, I got to make an announcement. And I don't mean this in a mean way, but we just had a senator pass away, Feinstein. And I believe we're just finished a Jewish feast day on God's calendar. And then there's a new one coming, I think, tonight. And it's interesting because Ruth Bader Ginsburg also passed away during one of those events. Same time of year, if I remember right. Interesting. Hope you got something out of this. The economic ninja is going to Vegas. Silver.